As the U.S. markets are now closed for the weekend, Chevron Corporation finished Friday's session, October 31, 2025, at $158.34, surging $4.80 or 3.13% by the closing bell. Now, on the surface, that's a very strong end to the week. But what's truly remarkable is that this pop happened on the very day the company released earnings that investors were bracing for, with many expecting a significant miss due to persistently weak crude oil prices. The common narrative was that lower commodity realizations, which had been plaguing the entire sector, would finally catch up to Chevron, forcing earnings down and proving the stock was overvalued. This expectation versus reality disconnect is where the real story is. The market was looking at the weak macro picture, but it completely underestimated the new engine Chevron just bolted onto its operations, the Hess acquisition. The reality is that Chevron's adjusted earnings of $1.85 per share firmly beat analyst estimates, which were hovering closer to the $1.66 to $1.75 range. The company didn't just meet expectations, it demonstrated that its strategic shift has fundamentally changed its resilience to commodity cycles. And that's the insight that seems to be driving this fresh buying interest. This recent 3% surge wasn't just a relief rally, it was a re-evaluation. For weeks, the stock had been trading sluggishly, underperforming high flyers in tech like Nvidia stock or even the broader indices. Many investors managing their own portfolios, perhaps using SoFi Invest or a Robinhood account, likely saw the downtrend in oil and trimmed their energy exposure. The expectation was simple. Lower oil prices, which have been stuck in the 60s, would mean lower upstream profits, and that would be the end of the story. Analysts had been lowering their forecasts, with Zacks even placing a sell rank on the stock heading into the report, citing a poor revisions trend. This is the narrative that was baked into the price before Friday. But the reality presented in the third quarter report was far more complex and, for long-term bulls, far more encouraging. The beat wasn't driven by a sudden, unexpected spike in oil. It was driven by two factors the market wasn't properly modeling: record-high production and stellar downstream performance. This is why self-investing requires looking past the headline commodity price. You have to understand the operational guts of the company. Let's look at the movement. The stock opened around $155.72 and ground its way up to a high of $158.86 during the session, before settling slightly lower at the close. The volume was significant, clocking in at over 38 million shares, well above its average. This isn't just passive Fidelity ETFs rebalancing, this is active managers and algorithms reacting to new information. The key takeaway from the earnings call was that worldwide net oil equivalent production hit a company record 4.1 million barrels per day. That's a 21% increase from the same time last year. Where did that come from? It came directly from the Hess assets, which contributed nearly 500,000 barrels per day. The acquisition, which closed back in July, is no longer a theoretical future benefit. It is the primary driver of Chevron's current operational strength. While legacy upstream profits were indeed down compared to last year's records, the sheer volume from new assets in Guyana and the Bakken, combined with a near doubling of profits in the downstream, refining segment, more than compensated for the weaker crude prices. The refining arm benefited from higher margins, turning cheaper crude into valuable products, a classic hedge for an integrated major that many retail investors, even those using sophisticated platforms like interactive brokers, often forget. The macroeconomic environment remains the single biggest headwind. We are in a period of high global supply. OPEC Plus has been signaling a cautious easing of its production cuts, adding modest amounts back into the market in November and December. This is intended to prevent price shocks, but it also creates a ceiling for crude, with forecasts suggesting a potential supply surplus heading into 2026. This is the reality that has kept a lid on the entire sector, making it a frustrating investment for those seeking the kind of parabolic gains seen in Tesla stock or Apple stock over the last decade. But Chevron's management seems to be playing a different game. They are not waiting for $100 oil. Their strategy, crystallized by the Hess deal, is about building a portfolio that can generate massive free cash flow even at $60 or $70 oil. This is what separates them from pure-play producers. While the macro picture is pressuring crude prices, Chevron's management is focusing on what it can control: costs and volume. The company is already claiming $1 billion in annual run rate synergies from the Hess integration, a figure they expect to hit by the end of 2025. This focus on operational efficiency and cost-cutting is precisely what long-term investors, like those using Schwab Intelligent Portfolios or Fidelity Wealth Management, want to see. For those who might be new to the name, Chevron Corporation isn't just a chain of gas stations. It's one of the world's largest integrated energy companies. This means it operates across the entire value chain. Its upstream business finds and extracts crude oil and natural gas all over the world, from the Permian Basin in Texas to offshore Australia, and now, crucially, Guyana. Its downstream business takes that crude oil and refines it into gasoline, diesel, and jet fuel, and also manufactures chemicals and lubricants. This integrated model is designed for stability. When oil prices are high, the upstream business thrives. When oil prices are low, the downstream business often benefits from cheaper feedstock, boosting its own profitability. This is the textbook business model. But the big story of the last year, and the one that defines its future, was the $55 billion all-stock acquisition of Hess Corporation. This move was a massive bet on the future of oil and gas, securing Chevron a 30% stake in the Stabroek Block in Guyana, one of the largest oil discoveries of the last decade, and adding significant acreage in the U.S. Bakken Shale. The company is now aggressively developing these assets, with the Yellowtail project in Guyana achieving its first oil and the seventh development, Hammerhead, just being sanctioned. This brings us to the future outlook, and it's a perfect case of expectation versus reality. The market's expectation is that as the world moves toward cleaner energy, big oil is a dying business. The reality, at least for Chevron, is that they are building a fortress of cash flow designed to last for decades, funded by these new low-cost barrels from Guyana. The company's future rests on this central tension. Management just returned $6 billion to shareholders in the third quarter alone, $3.4 billion in dividends and $2.6 billion in share buybacks. They also declared the next quarterly dividend of $1.71 per share. This is the reality of their financial strength. This isn't a company struggling for survival, it's a company executing a long-term plan to become the last producer standing, funding massive shareholder returns along the way. For anyone online investing and looking at their Fidelity IRAs, this is the bull case. Chevron becomes a cash-generating machine that funds your retirement through dividends regardless of whether oil is at $60 or $90. You're not buying it for explosive growth like Robinhood Crypto. You're buying it for the compounding power of its dividend, which it has raised for 38 consecutive years. However, the risks are just as real. The primary risk remains the macroeconomic picture. If global economic growth slows significantly, or if non-OPEC Plus supply, like from the US and Brazil, continues to overwhelm demand, oil prices could break below $60. In that scenario, even Chevron's low-cost assets would feel the squeeze, and the company's ability to maintain its aggressive buyback program would be questioned. Furthermore, the integration of Hess, while management claims it is progressing well, is a massive undertaking. These mega mergers are fraught with execution risk, and any stumbles in achieving those $1 billion in synergies could cause Wall Street to punish the stock. This is a story that investors on every platform, from the Fidelity mobile app to the professional-grade interactive brokers platform, are watching closely. The bear case is that Chevron paid a high price for Hess right at a potential cyclical top for energy and will now be forced to digest this massive acquisition during a period of declining commodity prices. This is why, despite the earnings beat, many analysts remain cautious about the 2026 outlook. I'm curious to hear what you think. Comment below with your thoughts on the Hess acquisition. Do you see it as a brilliant long-term strategic move or as a high-risk bet made at the wrong time? As we wrap up, the story of Chevron is one of profound strategic transformation. The expectation heading into Friday was for a company struggling under the weight of weak oil prices. The reality was a company demonstrating surprising resilience, proving that its new, larger scale, thanks to the Hess deal, allows it to generate significant cash flow even in a difficult macro environment. The strong pop in the stock was the market quickly recalibrating this new reality. The path forward for this investment will be a tug-of-war between the bearish reality of a well-supplied global oil market and the bullish reality of Chevron's record-breaking, high-margin production in Guyana. The company has given investors a clear view of its new operational strength. The question